Hello and welcome to this session in which we will discuss itemized versus standard deduction. When to use the itemized deduction, when to use the standard deduction. Let's review real quick of what is the standard deduction and what is the itemized deduction. The standard deduction is a fixed amount provided to you by the government that reduces your taxable income. For example, for a particular year, depending on your filing status, you can deduct, for example, $14,000 or $18,000 or whatever that number is. It's a fixed number per year that changes every year. Obviously, it's provided by the government. It depends on your filing status. And it's going to reduce your taxable income. That's one option. So one option is to take that number that's given by the government. The other option is to list all your itemized deduction, which are specific expenses allowed by the IRS that you can deduct from your taxable income, or you choose to. You'll add up all these deductions. We're going to see what they are. And if the total is greater than what's given, you will choose the greater of the two. If the total is greater than the given, you would choose the itemized deduction. If given by the government, whatever that number is, the standard deduction is greater, you will use that standard deduction. So you will choose in between those two figures, the greater of these two, because it's going to reduce your taxable income. That's what you want. And this is what we will discuss in this session, a little bit more on how to come up with this conclusion. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
First, I'm going to show you where the standard deduction can be found. If you look at your 1040, and this is for a particular year, 2023, this could be different in other years. If you look down here, it says standard deduction. For example, single, $13,850. Married filing jointly or qualifying surviving spouse, $27,700. This will change if you're looking in this recording in 24, 25, 26, so on and so forth. But the point is this number is given by the government and it's fixed. Head of a household, $20,800. So that's the standard deduction. That's one option. You would use this option, or you would use what we called itemized deduction. Itemized deduction, they go on Schedule A. Again, this is what the form would look like, and there are 5 of them: medical and dental expenses, taxes you paid, interest you paid, gift, casualty and theft losses, and there's a 6, which is miscellaneous category, 6 section. Now, what we did, I cover each section separately, and some of them, for example, charitable contribution, I had maybe 3 or 4 sessions explaining charitable contribution, but you need to learn about each one of them separately. Let's review real quick the list of the itemized deduction. Medical expenses, how much can you deduct? You can deduct medical expenses to the extent that they exceed 7.5% of your AGI. Once again, this is not a lesson, or this is not a lecture about any specific itemized deduction. This is an overview. State and local taxes, abbreviated as SALT, include state and local income, sales, and property taxes, but the total deduction is capped at $10,000. That's the second. Interest expense. This includes deduction for interest on home mortgage and investment interest. Again, there are specific rules for each section. I'm going through an overview. Charitable contribution, donation made to qualified charities. Casualty and theft losses, deduction are permitted for losses due to casualty and theft law, but only in the event in a federally declared disaster area. And these losses are deductible to the extent that they exceed $100, and the aggregate of these losses, they are greater than 10% of your adjusted gross income. Now, the best way to illustrate itemized versus standard is to work an example. And the reason I'm doing this is what? Is we are going to see different strategies when it comes to itemize versus standard deduction. Specifically, how to use itemized deduction in terms of tax planning. So this is an introductory session for that tax planning session. So let's go ahead and work this example to give us an idea what are we talking about from a practical perspective. we have John and Judy. John is $40,000 in wages. Judy is $60,000. They have unreimbursed medical expenses, $8,000 for John, $1,000 for Judy. State income taxes, $2,000 for John, $5,000 for Judy. State property taxes, $3,000 for John, $3,000 for Judy. Mortgage interest combined, $7,500. And they had casualty loss in a federally disastered area of $14,000 after the $100 floor deduction. The standard deduction for this particular year is $27,700. Now we're going to compute assuming that they are married filing jointly. So here's what's going to happen. If they use their standard deduction, they're going to take $100,000 minus $27,700. Therefore, taxable income, their taxable income will be $72,300. Let's assume they itemized. Well, if they itemized, they can take of medical expenses $1,500, which is they have in total $9,000, together $9,000, and medical expenses are deducted for the amount 7.5 above AGI. Well, what's their AGI is 100,000, 7.5 is 7,500. The amount above that is only 1,500. State and local income taxes. Well, obviously, if we look at state and local income taxes altogether, 2 plus 5, 7 plus 3, 10 plus 3, 13. Remember 13, but there's a limit of 10,000. Therefore, they can take 10,000. Home mortgage, 7,500. Casualty and theft losses, they have 14,000. You can only take the amount that's 10% above adjusted gross income. Your wages is 100,000. Their 10% of adjusted gross income is 10. 14,000 is 4,000 more than 10. They can take this 4,000. So for the casualty loss to be deductible, it has to be more than 10% of AGI. For the medical expense to be deductible, it has to be more than 7.5% of adjusted gross income. Now, if we combine all the itemized deduction, they add up to 23,000. So their taxable income is 100,000 minus 23,000. If they use the itemized deduction, their taxable income is 27. What would John and Judy use? Would they use the standard deduction or would they use the itemized deduction? Obviously, in this example, we did all this work, but it was not needed because what's given by the government is 27,700, and we're going to take the standard deduction because it's greater than the itemized deduction. So the question is, what can we do in order to increase itemized deductions? Okay, and this is what we will discuss next. So a concept called bunching itemized deduction. Now, how do we bunch itemized deduction? We will see. It's part of the tax planning. What should you do now? You want to go to Farhat lectures, look at additional resources. If you don't know what itemized deduction is, you want to go to my itemized deduction lesson. And for example, if you're studying for the CPA exam, and if you're taking directs, if you took direct section, this is where you learn about the itemized deduction. Now, if you're taking TCP, tax compliance and planning, the assumption is you already know what itemized deduction are because most likely you took the reg exam. This is what we will discuss in the next session, how to bunch, how to make itemized deduction greater than standard deduction, if we can legally, of course, to have more deduction. Invest in yourself, study for your CPA exam. Farhat is always here to help, and stay safe.